In this video I'm going to look at why Berkshire Hathaway does not pay a dividend. I'm going to argue that this is a very sensible course and that it's done very well for shareholders, and hopefully you'll understand why Berkshire is set up that way after watching this. And I've just put a quote here from Charlie Munger, which is, "I think that some of you will live to see a Berkshire dividend, but I hope I don't." That's very frank, and I think he's quite right in saying that. We'll start with some basic questions and some observations. The first question is, can you invest money better than Warren Buffett and co? So that's Warren Buffett and the other managers like Munger, Todd Combs, Ajit Jain, and other people involved in Berkshire. And if you think you can do better, I think you probably want to rethink that. It's very unlikely. And also, you have to ask yourself, do you own several businesses in which you can invest directly who will generate a very good return on investment? That's also quite unlikely. And some observations are that the long-term return generated by Berkshire is greater than the return on S&P 500, which means that most investors would have earned less investing dividends elsewhere. So if you'd taken your Berkshire dividends and bought into other companies in the S&P 500, statistically speaking, the investors would have done worse. So Berkshire dividends would have made long-term shareholders far poorer. That's very important, and it justifies, I would say, Berkshire's non-payment of a dividend over most of its history. It paid a dividend very early on, I think in '65. But then people say, well, what if I just bought more shares? I can take my Berkshire dividend and I can buy more shares. Reinvest your dividends, very sensible thing to do. However, you have to think about your compounding externally as opposed to internally. You're taking your profits and reinvesting them to compound them, but you're taking them out of Berkshire and then putting them kind of back in. Whereas why not just keep them inside Berkshire? That's far more sensible. And you'd also experience trading costs and taxes. That's going to eat out your return. So it's more expensive to compound externally than internally. You're losing some of your return, and you wouldn't have done better investing in other companies, and you're also starting at a disadvantage by having the dividend paid out. Taxes are also very important. One good way to think about not paying these taxes straight away, you're deferring them for as long as possible. You're getting to compound the tax that you haven't paid. It's essentially an interest-free loan, and compounding that can do very, very well over the long term. And capital gains tax, which is a tax for the increase in the value of your holdings in Berkshire, is cheaper than paying dividend taxes every year or twice a year. You also have to consider the structure of Berkshire. I would argue that Berkshire needs large amounts of cash. What it does is kind of dependent on liquidity. It's able to take advantages of opportunities. If Berkshire didn't hold lots of cash and have lots of liquidity when Goldman Sachs offered it that great preference share issue, or Bank of America, or General Electric, it would have had to say no to all of those. It wouldn't have been able to take advantage of all those great opportunities or make the big acquisitions like Burlington North. Also maintains a very good credit rating, and its reinsurance business, sometimes freak events can happen and it'll cause great strain if Berkshire didn't have a lot of cash, i.e. hurricanes, 9/11, and you don't want to have to sell stock and charge all those capital gains tax when selling them at unfavourable prices. And remember, Berkshire owns lots of very, very high quality businesses that generate very high returns on invested capital, so it invests directly in its subsidiaries. It spent quite a lot of money investing in Mid-American Energy and has done very well. But it's not true for all companies. That's very important to know. Growing some businesses destroys value. You do not want some businesses to retain cash. A very cheeky example of this would be Berkshire Hathaway. That is the original textile business. That's a business that was at a competitive disadvantage, and it was in the declining industry. So taking all its cash and investing it in growing the business is not a sensible strategy. It's destroying value. Buffett eloquently describes it as throwing good money after bad. So you want that company to pay a dividend. Also, some companies just don't need to heavily reinvest profits. Good example is Moody's. If Moody's retained all of its earnings for the next 20 years and invested in growing the business, it probably wouldn't do very much for shareholders. Moody's has got such a strong business as it is. It's often operated with negative book value, which is quite impressive. So I don't want you to take from this video that dividends are bad. You just have to look at the companies individually and decide whether you want the company to be retaining earnings or paying dividends. And if there's discrepancy in that, maybe that gives you an indication of the value you would put on it. And just for some more information, I'd recommend you look at the Berkshire's annual report. In the 2012 report, Buffett actually explains, I think it's page 19 to 21, why it doesn't pay a dividend. I've linked to that in the description. And I also recommend Buffett Beyond Value by Prem Jain. That gives you very good insights into Berkshire and how it works, which will also further help you understand why it doesn't pay a dividend. So hopefully this has answered your questions.